In this video, I'll reveal the healthcare hack that makes early retirement feel easy and how the ACA marketplace can save you $20,000 a year so the years before Medicare don't hold you back. As a certified financial planner, I've helped clients retire years earlier by mastering these exact rules. I've seen couples with $3 million in assets panic over $24,000 premiums, while others worth the same amount pay nothing. The difference isn't luck or connections, it's about understanding how ACA credits and modified adjusted gross income really work, something most advisors don't understand or fully explain. And that's why I'm making this video to show you how to use the ACA as your secret weapon for early retirement and the critical situations where this whole strategy backfires. Let's get into it. Most people assume that early retirement means expensive healthcare because you lose employer coverage and have to pay brutal market rates. But what they don't realize is that the ACA marketplace can actually make healthcare cheaper than retirement during your working years if you understand the income thresholds. Think of modified adjusted gross income like looking at your financial house from the tax assessor's perspective versus the real estate agent's perspective. The tax assessor only sees what's officially on record, but not the full picture of your actual wealth or spending. The income threshold hack that saves $20,000 annually comes down to one number: staying under 150% of the federal poverty line, which is $30,000 in MAGI for couples in 2025. Hit this target, and the second lowest silver plan can potentially be completely free through premium tax credits. But here's the remarkable part. In most circumstances, you can still spend $120,000 annually while only showing $30,000 MAGI on your tax return. Modified adjusted gross income includes wages, traditional IRA withdrawals, taxable Social Security, pension income, and investment gains. But it completely excludes Roth withdrawals, principal from taxable accounts, cash reserves, and loan proceeds. I had a client couple we'll call Sarah and Mike, both 62, with 2.8 million in assets. They were convinced that they couldn't afford to retire because healthcare quotes were $21,000 a year. But when we restructured their income sources to only show $30,000 in MAGI, their premium contribution dropped to zero while maintaining their $120,000 lifestyle. Now, most people miss this because they think in terms of cash flow rather than taxable income. They see $120,000 going out and assume that means $120,000 of income for tax purposes. And that's the fundamental misunderstanding that keeps people working longer than necessary. But what if you could create that low income number while still spending even more? Everyone thinks, for example, Roth conversions are only for high earners who want to reduce future taxes. But the truth is, Roth conversions create the perfect bridge income for early retirement healthcare optimization. Think of Roth conversions like prepaying your toll road fees to avoid those traffic jams later. You pay the tax up front when you can pay for it, then cruise through retirement with tax-free withdrawals that don't affect your healthcare subsidies. Here's the precision. Roth withdrawals don't count towards MAGI at all. This lets you spend significantly more while maintaining subsidy eligibility. Take my client, I'll call him David, a 58-year-old who had $1.8 million in his 401k. We started converting $90,000 a year to Roth, which meant paying about $28,000 in taxes annually. Over 5 years, that added up to roughly $140,000, which was the same ballpark as his projected premiums. But the difference was, instead of paying it on premiums, David built a $450,000 tax-free Roth bucket he can now draw from without affecting his healthcare subsidies. By 63, he was funding a $120,000 lifestyle, $90,000 from Roth, $30,000 from traditional sources, while only showing $30,000 MAGI and paying nothing for health insurance. And this conversion timing is critical. You need to start 5 to 6 years before retirement because of this 5-year rule. Wait until 60 to start, and you'll be 65 before accessing those funds penalty-free. But here's what David told me that was interesting. The peace of mind from knowing that his healthcare was essentially free was worth more than the dollar savings. He stopped worrying about premium increases and started focusing on what he actually wanted to do in retirement. Now, what if you didn't want to touch your Roth at all? There's another strategy that people completely overlook. Because conventional wisdom says you need to preserve cash and avoid spending down principal to maintain financial security. But there's a smarter approach where strategic principal spending can fund your lifestyle while preserving your most valuable tax advantage assets. So instead of depleting Roth accounts that can grow tax free for decades, you're instead spending down principal from cash and taxable accounts, which doesn't count as income for any tax purpose. I work with a couple, I'll call them Janet and Robert, who are in their early 60s with $800,000 in taxable accounts and $1.2 million in Roth IRAs. Their previous advisor wanted them to work until 65 just to be safe. But here's what we discovered: they had $300,000 in cash, essentially earning nothing. So instead of letting inflation erode that purchasing power, we used it as bridge income while letting their Roth accounts grow tax free. So the strategy was to spend $90,000 from the cash and principal of their investments and then carefully harvest $30,000 in capital gains annually. This created $30,000 in MAGI while funding the $120,000 lifestyle. They kept their healthcare costs at near zero, while their Roth accounts continued growing for their future high expense years or their heirs. And when done correctly, you're essentially getting paid to rebalance your portfolio while staying under MAGI thresholds. According to healthinsurance.org, 93% of marketplace enrollees receive premium subsidies, but they're not optimizing the subsidy because they don't understand income calculation differences. And this approach provides maximum flexibility too, because if healthcare rules change or a client situation evolves, they can always adjust capital gains realization up or down year by year. But the real magic happens when you blend it all together, because most people think you only need to pick one strategy and stick to it for simplicity, when in reality, the optimal approach integrates multiple income sources for maximum tax efficiency while maintaining some healthcare savings. So here's a sample refined structure. Take $30,000 from your traditional IRA, which maximizes your standard deduction if you're married, then take $20,000 from the Roth and $50,000 from taxable accounts and the principal, and then only realize $20,000 in capital gains. This altogether produces $50,000 of MAGI, which still qualifies for substantial premium tax credits while efficiently using the tax brackets. So instead of just minimizing your income, you're optimizing across multiple financial goals simultaneously. And this $30,000 traditional IRA withdrawal fills that standard deduction bucket with no income tax at 0%. The $20,000 Roth withdrawal provides tax-free cash flow, and the $50,000 principal spending reduces the taxable account that would face future capital gains. And the $20,000 capital gains gets taxed at favorable rates, likely staying within the 0% capital gains tax bracket for most couples. We were able to implement this for a couple I'll call Tom and Lisa, both also in their early 60s, who were paralyzed about early retirement. Using this blended approach, their healthcare premiums dropped from $18,000 annually to $3,600, saving over $14,000 per year. But their overall tax efficiency improved because we utilized multiple account types strategically. Most advisors miss this because they think in silos: Roth strategy or withdrawal sequencing or tax planning. Optimal retirement planning needs to integrate these strategies simultaneously while keeping your healthcare costs manageable. According to Kiplinger's 2025 state tax analysis, 13 states don't tax retirement income at all, which makes this tax strategy even more powerful if you live in Washington, Florida, Texas, Nevada, or some of the other no tax states I'll mention later. Now that you understand these income strategies, if you're ready to optimize your retirement strategy and protect your financial future, click a link in the description to book a call with me, and I'll give you some actionable advice for your exact situation. Now, there's an urgent timing factor that makes this whole strategy even more critical right now, because people assume ACA subsidies will always be available at current levels. But the reality is much different. Miss the 2025 deadline, and your $3,000 healthcare bill might balloon to be multiples higher overnight. 2025 maintains an 8.5% maximum premium contribution regardless of income level, but due to the One Big Beautiful Bill, 2026 eliminates premium tax credits entirely for income over 400% of federal poverty line. For couples, 400% of the poverty tier is around $80,000 in 2026. Crossing that threshold and you lose subsidies entirely, no gradual phase out. You go from subsidized premiums to paying full freight. I've been telling clients who are on the fence about timing to seriously consider 2025 implementation. Now, the difference between retiring with expanded subsidies and versus the old cliff structure could mean $15,000 a year in healthcare costs for many couples. In addition, the 2025 Trump tax law didn't extend ACA premium subsidies, making income optimization strategies more valuable than ever for those who can implement them before enhanced benefits expire. Now, this isn't fear mongering, it's just mathematical reality based on congressional action that affects millions of early retirees. So, you might be asking, how do you make this work for your life right now? Let's walk through an implementation framework. Step one is asset inventory and MAGI modeling. You need to calculate your current asset allocation across traditional IRAs, Roth accounts, and taxable investments and cash. Model 3 to 5 different withdrawal scenarios to determine your optimal MAGI target based on your lifestyle needs. Step two is retirement planning. If you want to retire in 2 to 3 years, consider saving in non retirement accounts immediately. If you have 5+ years to go, you can start Roth conversions early to take advantage of that 5-year rule. Step three is geographic optimization. Consider the 9 states with no income tax, which include Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming, where your MAGI planning becomes even simpler without the state tax complications. Step four is liquidity management. Consider having 2 to 3 years of expenses in cash or equivalents to avoid forced suboptimal withdrawals during market downturns that could spike your MAGI unexpectedly. Most people try to DIY this planning, but the interaction between the ACA rules, tax optimization, and withdrawal sequencing is complex enough that professional advice often pays for itself through better outcomes. And don't forget to also factor in projections that can account for potential additional income like inheritances and unexpected sources like consulting work you didn't plan on. Many MAGI plans fail because people forget about other income sources that kick in later. The key is starting with comprehensive planning rather than trying to optimize one piece at a time. Healthcare management costs should integrate with your overall retirement strategy, not drive it. Now, before I reveal the top 3 ways that this whole approach can backfire, there's one trap that deserves its own warning, and that's subsidy repayment. ACA subsidies are based on the income you project, but they're reconciled against your actual MAGI at tax time. If you underestimate, maybe you pick up side income, your investments realize bigger gains than you expected, or you have an unplanned IRA distribution, you'll owe back the excess subsidies. So that's why I always tell clients, don't aim for the absolute razor's edge of their income threshold. You want to build in a buffer so that your plan still works even if something unexpected pushes your income higher. But here's what most advisors won't tell you about when this strategy can seriously backfire. While it can save you $20,000 plus annually, it can backfire spectacularly if you overlook these 3 mistakes. Number one is the tax bracket. I've seen people avoid beneficial Roth conversions when they're in the 12% tax bracket solely to keep MAGI low for ACA purposes. They're trading long-term tax efficiency that could be worth tens of thousands of dollars for short-term healthcare savings that's worth thousands. Sometimes paying $15,000 a year for health insurance while doing $100,000 Roth conversions at 12% can be better than paying next to nothing for insurance if you're missing out Roth conversion opportunities that will cost you 22% later. Risk number two is depleting emergency funds. I had a prospective client who wanted to spend his entire 200 grand in cash in 2 years to minimize his MAGI. This would have left him with no emergency fund and forced bad withdrawal timing during market volatility. Your financial security shouldn't depend on perfect income engineering year after year. If your plan only works with surgical precision, it's probably not robust enough for real life. And risk number 3 is the complexity burnout. The administrative complexity of managing multiple income sources, timing withdrawals perfectly, and tracking MAGI implications can be overwhelming. Some people prefer paying more for simplicity, and that's valid. The strategy doesn't work well for people who want to work part-time in retirement either. Consulting income or business income can quickly push you over these subsidy thresholds. At the end of the day, don't let the tail wag the dog by optimizing for healthcare savings at the expense of better financial outcomes. So, now that you know the power and the pitfalls, here's how to use it the right way. This hack that makes early retirement feel easy isn't about gaming the system. It's about understanding how the ACA marketplace is designed and aligning your income sources accordingly. The key insight in all this is that healthcare costs don't have to derail your early retirement dreams if you plan your income sources strategically rather than just hoping for the best. But remember, it's not about minimizing healthcare costs, it's about creating sustainable income strategies to support your overall goals. The best approach, in my opinion, integrates healthcare planning, tax optimization, withdrawal sequencing, and estate planning, and treating them as dominoes rather than silos. The strategies we're covering work brilliantly for the right people and the right circumstances, but they can be problematic for others who try to force them when they don't fit. As I tell clients, you only retire once, so let's do it right with planning that optimizes your total situation, not just one component. If you are ready to get professional guidance on optimizing your retirement strategy and building the retirement you've always wanted, click the link in the description and book a call with me. Thanks for watching, and I'll see you in the next video.